Hi, Kurt and Shelley. Good to see you again. Thanks for coming in and meeting with me again. I appreciate the time you took out of your day to make that happen. I also appreciate all the information you provided in our last meeting so I could sit down and start to develop your financial plan. As we stated before, part of the planning process, the beginning part of that was to define our relationship, where we talked about what services I would provide, compensation, our expectations for each other as a client and as a planner for you, and how we were going to work together, and then what decisions we were going to be making for your financial plan, and how long we were going to be working together in this financial planner relationship. So once we did that, you gave me that information that I asked for. You gave me some goals and provided some expectations on what you wanted me to do with that information, how I could formulate that for you and present those goals back to you. The next step that I took for you was to analyze your financial status and review those goals, at which point I sat down and developed some recommendations based on the information that you provided. That brings us to where we are today, so we can talk about how we did that, what information we decided to use to make those recommendations, and how we're going to move forward with that information. Now, after we talk about the recommendations today, what we're going to do is we're going to have you implement any recommendations that you agree with, and then once those recommendations have been implemented, then we'll continue to monitor those recommendations throughout our time together to make sure we don't need to make any tweaks or changes as life comes up and happens. We're very flexible. We can always work with you, making those necessary adjustments as need be. So with that being said, we'll get right into one of the recommendations that you had asked me about, specifically the distribution from your Roth to cover those expenses that you needed for the lawsuit. You had mentioned that you needed to basically come about $26,000 for a lawsuit, and you had money set aside in your Roth, Kurt, that you had been contributing to for about 10 years. Looking at your Roth IRA, calculating the contributions, it looks like over the last 10 years you've contributed $28,000 to that account. What that means with Roth IRAs is any contributions that you've made can be taken back out tax and penalty free. So if you wanted to have access to $26,000 worth of the funds in that Roth IRA, you absolutely could, and you wouldn't have to worry about paying any taxes on that money, and you wouldn't be penalized by the IRS for taking an early distribution even though you're not 59 and a half. Now, with that being said, I also looked at the inherited IRA, inherited Roth IRA that Shelley was bequeathed. And it looks like there's plenty of money in that inherited IRA to also cover the $26,000 that you're needing to cover this legal expense. Now, I might recommend that you take the distribution from that inherited IRA as opposed to your own Roth IRA, Kurt, and here's why. With the inherited Roth IRA, every year you're going to have required minimum distribution, or an RMD as it's known, where the IRS basically says you inherited this money, even though the taxes have already been paid on it since it was a Roth IRA, they still require you to take out a percentage of that account every year so you draw down that balance. Without knowing a little bit more details about the actual original owner of the account, I can't tell you exactly what your required minimum distribution would be at this point. However, any amount that you take out to use for this $26,000 would count towards any current year required minimum distribution that you have to take. The reason I suggest that you take the money from the inherited Roth IRA instead of your own Roth IRA is because your Roth IRA doesn't have that required minimum distribution. Even after you reach age 59 and a half, that account will still be able to continue to grow tax deferred without that requirement to pull the funds out. So, since you have to take the funds out of the inherited IRA anyway, I feel like this is a good chance to make use of that and put it towards that $26,000 that you need for the legal expense. Now, one of the other recommendations that I wanted to talk to you about today was the earnings calculation for your business. You had mentioned to me, Kurt, that you had done some reading on like capitalized earnings valuation and calculating the earnings based on a discount rate. Now, I took your previous 3 years worth of earnings in the business, 2015, 2016, and 2017, and we averaged out those earnings over the last 3 years, and that came to an average of $64,366 and approximately 67 cents. What that was your $50,500 in earnings from 2015, your $59,600 in earnings from 2016, and your $76,000 in earnings from 2017, just simply added up and then divided by 3 since it was 3 years. Now, using the capitalized earnings valuation with the discount rate calculation, we basically just then take that average of your earnings per year and we multiply it by the discount rate that you wanted to use to evaluate your company. In this case, you suggested 20%. So you take that $64,366.67 and you multiply it by the 0.2 or the 20%, and that gives you a capitalized earnings valuation for Uncle Jay's of $321,833 and approximately 33 cents. Now, based on this model, I noticed that was quite a bit higher than what you had listed as the valuation for your company on your financial report that you provided to me. You had listed the value at approximately $138,000. So using this valuation method, you can see there's quite a bit of difference where you'd be valuing your company with this method versus I'm not sure how you came to the valuation of $138,000, but this could, if you're looking to sell the company at any time in the future, be a much better method to calculate that value should you need to do so. Now, with that being said, there's a couple caveats to the capitalized earnings valuation method that I wanted to mention. One, earnings don't necessarily represent accurate cash flows for the business, so that doesn't always transition into an accurate value 100% of the time. And that method also fails to account for residual value of the business assets at the end of any reporting period, which could actually increase the value. So there's a couple different things to think about when you look at this type of valuation method in regards to the business. Now, if you're not comfortable using that valuation method, or if you wanted to talk more about the method that you used to reach the original $138,000 that you did, I'd be more than happy to set up another follow-up appointment with you. We can go over that information and maybe update this recommendation as need be. Looking at these two recommendations moving forward, as I said earlier, we'll go ahead and implement any recommendations for the distribution of the $26,000 or the earnings valuation for your business into your plan, and then we'll monitor how the situation works out over the term of our relationship and update these as need be. If you have any other questions, definitely please let me know and I'll follow up with you soon. Thanks a lot. Have a great day.